Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and or financial topics. I'm going to interject my financial opinion as we go, and let's dive in there and see what people are talking about in the financial markets. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. That's where I go over individual companies, individual stocks, um, going over sectors, and I do lots of trainings in the beginning of our question and answer sessions that we have during the weekends. So starting off with just Uranium Insider, he says, not only did the previous bull market not have these drivers, it had greater than 4 per year in secondary supply from the warhead downblending over in Russia. So that was enrichment underfeeding and tails re-enrichment. Secondary supply today is less than half of what it was in '02 and '07. So during the 2002-2007 uranium bull market, there was no supply deficit, no nuclear renaissance, no global triple nuclear pledge, no demand for carbon-free energy for net zero, no auto industry transition to EVs charged with clean energy, no Bitcoin, cryptocurrency mining, or any of that stuff. AI, artificial intelligence, is a huge for electricity. We also need to basically upgrade our grids too for all this electrical demand. So here's the 308 price. Looking at this thing over time, big move in the 70s, another gigantic move in the early to middle of 2000s, and then we've got a nice big roundish bottom, just like the potential 90s. Now, someone had said that potentially we're here at 1996 and that we've got a downward move before, and maybe we do a double bottom. I don't know about that. I I think that's kind of pushing it. Um, I do think that we're probably at a price, and we're probably going to have to go higher to turn on more uranium production. And I think the shortage is now. So the way that I view it is that the price is going to have to continue to go up, or at least stay at an elevated level for a long period of time to incentivize production to really start to move to the upside. If there really is the supply demand deficit that I think a lot of us have seen in the charts, um, it, again, uranium is difficult to know exactly where it's at because no one knows the actual inventory levels. But I do think that we are going to squeeze up. Now, does that mean that the price goes to 200 immediately? I don't know. I don't know when that squeeze will necessarily occur, but I'm sure at the current price that we're roughly at, 100 ish, um, it could turn on some supply and it could delay the big spike that we do get. Every single time in history, these were driven by credit growing faster than supply for commodities in general. And money went and shifted towards the commodity sectors. This was not driven by uranium. This was not driven by uranium solely. This here is not solely driven by uranium. It's a combination of things where you get in the backdrop, there is credit being created, or credit is coming into the system through either fiscal ways or through monetary ways, coming into the system at a faster pace than, let's say, oil, perhaps. 1970 was an oil crisis, and money shifted towards commodities during that crisis. And money was being created at a faster pace than commodities were, and it was very inflationary. The same thing occurred in the 2000s. It was a real estate boom, monetary expansion was created faster than what commodities could keep up, and money rotated towards commodities. And we've got a similar situation occurring today. So it's not just uranium. that people should be looking at. It should be how much credit is coming into the system, and is the commodity side keeping up with it? If it's not, then money's going to rotate towards solving the problems. It's going to rotate towards commodities. Here's Tracy. She says the nation's 2,700 data centers sapped more than 4% of the country's total electricity in 2022, according to the International Energy Agency. Its projections show that by 2026, they will consume 6%. So data center energy demand in gigawatts, each gigawatt is roughly the amount of power generated by a large nuclear plant. We've got massive growth in these US data centers in terms of power needs or demand. Here's Eric. He says the youth in the East are buying physical gold, while the youth in the West are buying Joe Bodon, Elizabeth Warren, and Jester Trudeau, fairy dust crypto coins in this clown world that's occurring in the West. Brian says to build wealth quickly, concentrate your portfolio and add leverage. Conversely, to destroy wealth quickly, concentrate your portfolio and add leverage. It cuts both ways. If you want to make money very quickly, that's exactly how you do it. Concentrate and add leverage. But that can also blow up in your face. You know, one thing that I have found with a lot of these guys who do make a lot of money, what they look for is they look for high probability bets where there might not be a lot of downside, but there could be a good amount of upside. They're looking for symmetry. And let's say that the move doesn't necessarily yield a very big move. The way that they create a big move out of it is they add leverage. That's how some of these guys play the markets. They find a high probability bet. Let's just say, for example, that we've got a recession that's potentially coming. And the Federal Reserve thinks that they're going to lower rates or something on the lines of that. So what someone would do is they would bet on bonds. They'd go long bonds and then bet that interest rates would go down. And then since there's a fair degree of certainty with that, where you think, you know, they're not going to raise rates, at least in this scenario that I'm describing. If they didn't think, well, you know, they're not really going to raise rates, more than likely it's all going to be to the downside. So they would add a bunch of leverage to it, or use products that are a little bit more leveraged than just buying some bonds. Here's the young pretender. Massive lines form across China as citizens rush to buy gold in an effort to preserve their wealth amidst a declining economy. How long until they start finding ways to obtain Bitcoin in this particular case? Now, another way to look at this is maybe China's doing this on purpose, and maybe they're pressuring their citizens to buy gold and force the United States to do something because China thinks that America is maybe manipulating the gold price. So what if we just get all of our citizens to start buying gold and soak up all of the physical gold in the world? But that is interesting there. Holger says, maybe I should buy some Bitcoin. It says Bill Ackman, the founder and CEO of Pershing Square Capital Management, sparked a lively discussion within the cryptocurrency community with a hypothetical scenario where the price of Bitcoin could escalate dramatically. Ackman suggested that an increase in Bitcoin's price could lead to more mining activity. This, in turn, would drive up energy consumption, causing a rise in energy costs and inflation, which could devalue the dollar and further increase demand for Bitcoin. Ackman's speculative loop hinted at a cycle of rising Bitcoin prices and energy costs, potentially leading to economic instability. And this is record energy use. Electricity demand for Bitcoin mining hit a new high amid the latest bull run in terms of power draw over time. All I'm going to say is it seems like everything that we are doing is putting more uh, demand for electricity. These demand centers, these Bitcoin miners, electric vehicles, et cetera, et cetera, et cetera. So I, I think investing in the grid would be one way to really take advantage of this opportunity here, and or anything that generates the electricity or the power behind it. The fastest growing electrical power generator with probably the most robust designs are obviously nuclear power and natural gas. And then if we do get problems in supply chain, it's really going to slow down solar and wind. I think those are going to go down. They're not going to grow as fast as maybe before because of constraints on commodities. And then the cost of commodities increasing is going to make them less viable. So I think natural gas is probably the big winner here, is my guess. Eric, he says, I was just thinking of the same thing today. Many people are comparing the current gold market to 2008. They are fundamentally different. We were still in the USD and UST's hegemony world in 08, 2012. Today, we are on the cusp of leaving it. I agree with that. And it's not even that that's going to propel the gold market. It's not the cusp of necessarily leaving it. It's the energy demand versus the supply that's going to cause the inflation. Every single time we've had a problem, it's been credit growing at a faster rate than your supply of energy. If we're supply constrained on energy, it means you're going to go into a very inflationary world. Then it's the entire world that's participating in this. In the 1970s, it was just America, and we hit peak oil in 1970. In the mid 2000s, it was the housing bubble that was creating credit at a faster pace, and supply was constrained. That was basically a lot of people talking about peak oil in the mid 2000s. And now I think it is actually getting closer to the world producing about as much as we can in terms of oil. And we've got these debt problems all around the world. The debt problem is because of the energy. We can't grow at a fast enough pace in terms of GDP to balance out the credit expansion that's occurring on the debt side. And whenever that gets out of balance, that's when people are going to start to panic. It's going to panic first in the bond market and then second in the currency market. So what you're going to see is you're going to see interest rates shoot up with a panic. They're going to launch to the upside. And that's what you should be watching for. And when it starts to launch, it might be too late to get into the gold market or silver market because that's when they're going to go vertical. So you're going to be either in it or you're not going to be in it at all. It's always best to be a month, a year, 2 years, 10 years too early than a few days too late, because you're not going to be able to get access potentially to the physical market. It's just going to become unobtainium potentially. Here's Grady. So this is the silver roadmap chart, first posted in 2019. It's still showing the way. At perfect backtest in 2022, now sitting right below the blue breakout line, silver's getting ready. Bull market price objective is $370 an ounce, but could briefly go double that in a parabolic move at the end of the bull market, which means 720, 800, $1,000 is on the table. This is the big move that he is projecting. He's got the big Kondratiev wave overlaid on it. We've got a big move in the 1970s, pullback in the 1990s. We had the 2000 bottom, and then we've moved up to 2011. We've consolidated sideways and basically a gigantic handle. And we're right at that breakout, potential breakout here. So what he says is KWH, KWL is the Kondratiev wave high and low. This is the high and this is the low. And what he took is he took basically the size of this channel that we've been trading in from the early 70s to the top here, and then he projected this upward. 1006% upward move. So he's got a price objective of 370, but could also go much higher briefly at the end of the bull market for the Kondratiev wave high. He says the possible time span for the fifth K wave to top, and that's somewhere between 2028 and 2041. So most likely somewhere in the 2030s is what his projected top will be. If right translated, then we top beyond 2028, which would be very reasonable for this bull market. And we top in 2034 if the fifth K wave is similar to the fourth K wave. And he says down here, the fifth Kondratiev wave, K waves, have lasted 54 years on average. And here we are moving on up again, much like the 1980s to whatever, moving on up. And then we have another divergence here. We were negative. We're starting to come to the positive, hopefully very soon, where silver gets moving. Here's gold. This ratio chart shows that miners are most probably going to outperform general equities going forward. No need for great big picture charting to be complicated. So it begins in terms of the big asset rotation. Make the most of it. This is a 5-year bullish falling wedge. Let me zoom this in a little bit. There we go. It's a 5-year bullish falling wedge for GDX versus the S&P 500. And this is that big asset rotation that I always talked about in the early 2020s. When I first started the channel in 2020, I was like, money's going to rotate. Interest rates are going to go up. Inflation is going to go up. This is all of it playing on out. And GDX versus SPI, weekly gold miners versus general stock market, looking for an around the apex move after a false breakout. That's his own term and pattern here. So it's got a nice, good false breakout here. We've got a nice hammer candlestick with a big bullish piercing pattern, and we're starting to move higher against the S&P 500. It's going to probably be two things combined here. GDX is going to go up at the same time that the S&P 500 goes down, which is going to push this ratio way up relative to each other. Brian says, buy damaged stocks, avoid damaged companies. The stock is not the company itself. That is exactly what I look for. I buy companies, commodity companies, that are down. The stock is down, but the company itself is good. We're just in a out of favor market condition for the commodity itself. That's what I basically make my money on. It's out of favor sectors that I buy good companies in. I do not buy damaged companies. And generally, a damaged company will have a different looking chart pattern in the way that it moves than very good companies. Very good companies have clean looking chart patterns. They have clean bottoming patterns. And then they generally move very well with the underlying commodity. A damaged company generally doesn't move at all, and they're very weak, and they don't necessarily move with the underlying commodity, is what I've noticed. Energy headline, it says Saudi Aramco sees oil demand growth in 2024 at about 1.5 million barrels per day, says the chief executive, Amin Nasser. Here's silver divided by gold. This is getting ready, according to Hinster, right before the explosion here. We had a nice little kind of move higher in the silver to gold ratio at the same time that silver was basically squeezing. So silver is this bottom one. The ratio is the gold line. We've got the ratio that looks like it's ready to explode to the upside in favor of silver. And we are still squeezing, very similar like we did in 2010 before the big move. Let's hope that big move comes, and let's hope that the silver to gold ratio goes in a very favorable direction for silver. And then hopefully when we peak, that's when I'm going to rotate a lot of my silver into GOLD, gold. Don Durrett says, I'm probably wrong. Gary Savage, Michael Oliver, and Jordan Roy Byrne are calling this a breakout in gold. These are big names. I'm not getting excited until I see confirmation. Here is his reasons. There are four factors that imply we should be skeptical of that call. Silver is not confirming. Gold is at an all-time high, and silver is still stuck in the mud. Many silver producers are losing money at $24 silver or barely breaking even. Well, that's why I would buy physical silver. The Huey is not confirming. I've never seen gold miners lag a gold move like this. The Huey at 228 is in bearish territory. There is no fear on Wall Street. This is why the GLD continues to drop tons. How is that possible with gold up? Investors are selling the GLD while gold rises. They are selling gold and buying Bitcoin and Nvidia. Well, I agree with that. Yes. The stock market is getting ready to crash. Do you really think gold will fade that crash? I don't, in Don's opinion. So that is his opinion. Now, the question is the stock market really going to crash? That's number one. Number two, money is going into Bitcoin and Nvidia. If it does crash, that money's going to rotate out of it. That's hence the crash. And where's that money going to go? That could be the second question. And then I'm not going to make comments on the first two. But silver squeezing up, that generally lags gold. So we'll see. We'll see what occurs. For those keeping score at home, large cap technology as a sector is actually down over the past month. We've got a nice big bearish engulfing pattern here, this last candlestick. And the momentum looks like it's losing some momentum. So large cap technology doesn't look that great. And you can even draw a lineup here where it's wedging up into a corner with a bearish engulfing. That screams to me like we want to go lower, for me, in my opinion. Cross-border capital says exactly the reason Wall Street may not rise. Strong economies do not have strong financial markets because liquidity gets diverted. Liquidity in weak markets goes into the stock market, and you usually have lower interest rates during that time frame. Strong economies have an increasing interest rate environment, and generally you're building homes during that time frame. And stocks do not go up during that type of market condition. Cross-border also says further signs, Fed data, that world business is stabilizing. We can see that in world business climate, the orange, and also in world shipping activity. So we've been moving sideways in both of that. And maybe we are bottoming and ready to go up. We'll see. And that's all I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website. We still have LEAP coupon code, LEAP, if you'd like to save some money. It is still active. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.